Waiting for confirmation of streaming. So I have Facebook, it's confirmed. Waiting, okay, LinkedIn is confirmed. YouTube is confirmed. And Twitter is confirmed. Okay, wonderful. All right, and we're recording and we're live. Welcome to HGR Tax, a firm where we try to create these videos that demystify the sometimes confusing world of cross-border tax and compliance. And to do that today, we have a very special guest all the way from sunny Puerto Rico, and that's Giancarlo. Giancarlo, welcome. Please introduce yourself.
Thank you for the invitation and happy to be here. I know both of you, we are some kind of tax nerds, so probably I can elaborate from my side in Puerto Rico. So, and I would like to know more about your practice and how what we do from tax perspective and benefits in Puerto Rico compared with what you do in Dubai and Singapore. So let's talk about this some minutes.
Well, wonderful. And to those who may be watching us on whatever platform you're on, we invited you guys to submit questions in advance. Some of you did, and for that, we're grateful. We're going to go through them in the order in which we received it. If you guys have any questions, feel free to type in the box below, and time permitting, we will get to them in the order in which we received them. But do bear in mind that while we may be tax consultants, we are not your tax consultants. So we're having a general conversation, general principles. Nothing we're saying here should be construed as advice. If you want actionable intelligence tailor-made to your unique situation, you need to retain a firm or a team that you can instruct and that would guide you accordingly. So general conversation, general principles, this is not advice. And with that in mind, let's jump into the first question. Okay, this is very generic, very general. So what is the main attractiveness from, obviously Puerto Rico is a beautiful territory, a beautiful island, right? But from as a jurisdiction, what is the main benefit of moving to Puerto Rico from the US?
Yeah, well, let me give you some political status, what it means to be in Puerto Rico. Puerto Rico is a territory of the United States. But being a territory, we have some particular exemptions. But Puerto Ricans born and raised are U.S. citizens by birth. So that means that, you pay taxes to the U.S. based on citizenship. But there is a particular situation in the case of Puerto Rico bona fide residents, right? And Puerto Rico bona fide residents is particularly defined or provided by Section 937 of the U.S. tax code. And that basically allows Puerto Rico bona fide residents to not pay U.S. taxes on Puerto Rico source income. But it's Puerto Rico source income only based on Section 933. So those are the main two sections that allows Puerto Rico residents to not pay U.S. taxes. But that doesn't mean that if you generate income from other sources, interest, dividends, if you have a rental home in the US, that means US source income. So even that you live in Puerto Rico, you may be subject to US or state income taxes. Okay, so basically, one of the principal benefits of moving in or living in Puerto Rico for income taxes is principally those tax benefits that the Puerto Rico government has been offering for decades now. There is an evolution from manufacturing activities, from pharma, airplanes, systems, and services. And since 2012, basically, Puerto Rico enacted Act 20 and 22, that is now Act 60. But basically, those laws basically promotes the relocation of individuals and businesses to Puerto Rico under the premises that they will not pay U.S. taxes. But principally, the benefit is that if you live in Puerto Rico, if you comply with the bona fide resident test, that is a home test, present test, and closer connection, you will be able to exclude from U.S. gross income the Puerto Rico gross income. But basically, that's it. And under the tax benefits, it's principally associated in the case of the Individual Investors Act or Act 60 now, it's basically passive income. So it doesn't mean that you move to Puerto Rico and you will not pay more US taxes. So it's only a matter of interest, dividends, and certain capital gains from Puerto Rico sources. But you may be exempt at Puerto Rico level from dividends and interest income taxes. But if the interest and dividends are paid by a US entity or foreign entity, they are still foreign sources, right? Income to the US. So it's a matter of making sure that the analysis is completed accordingly with the law, taking into consideration that this is only an exemption at Puerto Rico level. So Puerto Rico may say this is exempt here, but the US may still charge some taxes on it. So it's kind of interesting, but principally and in Puerto Rico, commonly Puerto Rico residents doesn't pay US taxes if they are principally W2 persons, professional services, etc. So it's kind of interesting. But again, it's a territory. We are US citizens. We commonly don't pay US taxes to the extent that the income that we generate or the people generate in Puerto Rico are 100% right. So Puerto Rico source income based on the US tax law. So it's like a permission provided by the US tax code to generate some kind of income without paying US taxes.
Okay, understood. So this is, as you mentioned, it's at the equivalent of the federal level. You get tax relief from federal tax. If you have state source income from one of the other states or territories, it'll be subject to tax, as it normally would be. And you also mentioned it's particularly attractive to those who enjoy passive income, interest, dividends, capital gains. But if you have earned income, so for example, let's say you're a consultant and you sit in Puerto Rico, that income, that earned income would also be tax-free?
Yeah, well, basically, the earned income and the service income part is not free nor tax-free. There are tax benefits for that. And basically, that's another disposition that was previously under Act 20, now under Act 60. And this is the Export Service Act, or the export tax benefits, that basically allows a company or an individual to relocate to Puerto Rico or open a new company in Puerto Rico and export services from Puerto Rico to any part of the world. So if they provide the services while working in Puerto Rico, that you can say, hey, if you provided the services in Puerto Rico, that's Puerto Rico source income as described by the Puerto Rico tax code and the US tax code. That will be subject to a preferential tax rate of 4% tax. That is a flat tax of 4% tax. And if it is a company and the income that is generated is subject to the 4% tax, dividends paid by that income from that corporation are fully exempt. So that basically means that certainly if there is an owner employee, you need to analyze if they need to have a reasonable compensation, that he needs to pay their Social Security, Medicare taxes, some kind of income taxes on his part. But certainly dividends paid from retained earnings accumulated from the export service activity are exempt at the individual's level. So one of the best strategies certainly to, if the owner is a Puerto Rico bona fide resident and the corporation that provides the services is a Puerto Rico entity, dividends paid by that corporation are treated like Puerto Rico source income under the eyes of the IRS. So you will pay, or the company will pay 4% tax. Dividends received by the owner will be fully exempt at Puerto Rico and federal level. And the owner may pay some kind of income taxes on his W2 income and any other income that he may generate. But in Puerto Rico, commonly you will find the combination of individuals investors as owners of the export service activity as well. So they may have dividends and interest from other sources that will be exempt in Puerto Rico, probably interest and dividends paid by US corporations or in investors' accounts in the US or any other part of the world will be subject to federal taxes. But in the case of capital gains, they may be exempt in Puerto Rico. And in the case of capital gains, it's very important to take into consideration what the IRS says is that the capital gains has principally two rules applicable to Puerto Rico residents. If they are private equity, it depends on the holding period, right? If you move to Puerto Rico and you hold that investment for 10 years before moving in, that doesn't mean that the gain that you realize after you just move will be Puerto Rico source income, right? The IRS always say, hey, take a look back and let's calculate based on your holding period. So that's one of the principal errors that occurs. And the other side is the marketable securities that is based on fair market value as of the date of movement to Puerto Rico. So those individual investors decide, hey, if my investments were down at the time that I move, I may have a loss or minimum gain in the US, and any appreciation after moving to Puerto Rico is the one that will be treated as Puerto Rico source income. So it's a matter of analyzing correctly each taxpayer and what they have on their pockets to see how it benefits each one of them. Yeah.
Okay, so if I get it, so you have a company that's properly domiciled in Puerto Rico, and the nature of its business is export, so it doesn't have domestic source income, then the corporate tax will be 4%, right?
The corporate tax is 4% tax to the extent that it is export service.
It's export service.
Yeah.
And if it engaged in some sort of Puerto Rico domestic activity, then what will be the corporate tax on that?
Well, it's fluctuates from 18.5 up to 37.5. So it's dramatically they change. Yeah.
Okay. Understood. So I think that's pretty clear. So it's very attractive to those on so-called passive income, particularly capital gains. If it's a company, you just need to make sure that company is internationally focused, not domestic to Puerto Rico, and you get that 4%. But the dividends that are derived from it would also be tax-free, at least at the federal level. Okay, makes a lot of sense. So I noticed that you said it was Act 2022, which has now become Act 60.
Yeah.
So what have been the big changes from a legislative perspective recently?
Okay, well, Act 20 and 22 were enacted in 2012. In 2019, the Puerto Rico government basically decided to consolidate all the tax incentive in one law. It's Act 60 now. So that includes manufacturing, pharma, tourism, industrial, creative industries, etc., and includes as well individual investors and export services. Act 20 principally, that was the Export Service Act, requires basically only to the exportation of services and didn't have any particular requirement. At the beginning, they required 5 employees. They reduced the employee requirement. By the end, they didn't request any activity or basically employees. I always say to my clients, hey, you need to have some kind of employees on there. A company that exports services, right? It is expected that someone is providing services. So now under Act 60, that certificate part actually provides 2% at the beginning for the first years for small businesses. That means a company that sells less than 3 million. So it's not 4%, it's 2% at the beginning, 4% if you sell more. But at the time that you have more than 3 million in gross sales, you need to have at least 1 employee. That's one of the principal changes. In the case of Act 22, that is now Act 60 as well, individuals that relocated to Puerto Rico, certainly they have some change based on who is managing the government and politics. But now there is a requirement to make a 5,000 annual fee with a tax return associated with the annual compliance with the decree, and they need to make a $10,000 annual charitable contribution to a Puerto Rico non-for-profit, plus acquire a residence, their principal residence in Puerto Rico, within 2 years after movement. So before those changes under Act 60, people and people that apply before those changes have grandfather rules. So they may rent only, and they are in compliance. They don't need to, and the charitable contributions was there at the beginning. There were no charitable contributions. They implemented 5K by the end of Act 22, and now it's 10K every year. So it depends, right? When we do some kind of compliance for any Act 22 or this type of individuals, we need to take a look into the tax grant, right? The tax grant is a contract between the taxpayer, the government, and so they provide some protections to the individuals, investors, and the companies as well. And those are the rules, right? And the rules that applies are those that were valid at the time of the application. So that basically is the process to do that.
Okay, so really the rules were around what we would term economic substance. So you need, if you have a company, there must be local employees. It can't just be a shell company. You as an individual, you need to have your primary residence in Puerto Rico. But you mentioned that you had to buy a property. Can you rent? So you're not allowed to rent a primary residence? You have to purchase one?
That's a requirement within the first 2 years. As an individual that you relocate, and this rule is applicable only to the individuals, investors, right? That they need to buy their house. But basically, and this is not automatic, right? If you move and you have the benefits, you need to go through a process with the government, submit some kind of tax incentive applications. The government evaluates and then issue the tax decree. The important part here is that tax decrees may take some time, few months, or let's say a year from the government to issue the tax decree, but they are retroactive to the date that you apply for it. So basically, if you move and you commence operation, and let's say that you apply in February and you take your grant by December, it will be retroactive to February. That is the date that you commence operation. So those are some kind of benefits. Right now, actually, after the implementation of Act 60, there were a boom of applications because the Act 60 entered into effect January 1st, 2020. So there were a lot of applications by the end of 2019 trying to be grandfathered under the previous law. So that basically makes some efforts from the government. It's taking more time to get an approval, but they are now taking reasonable efforts to make it happen as soon as possible.
Okay, understood. So it's for the investors. So in terms of the property purchase, it'll be for those that come in as investors. If someone just relocates as an employee, like a chief whatever officer or CEO or something like that.
Most of the
Do they need
export
to buy?
companies is the same owner, the same employee. They can probably they move to Puerto Rico, they relocate with their family. They keep the business in the US and they charge some management fees from Puerto Rico. Certainly, it's always recommended to do some kind of transfer pricing to see
Of course, yeah.
to change. Even that Puerto Rico doesn't have some kind of transfer rules implemented. The Puerto Rico government commonly follows US guidelines. And certainly, if the company do business in the US, the expenses to a foreign control corporation will be under the same or under the eyes of the IRS as well. And Puerto Rico follows US GAAP, so arm's length transactions persist.
Right. So that's in terms of transfer pricing. But going back to someone who's not an investor per se, but they're just like a senior employee, let's say, in a company. And do they need to purchase a home as well, or can they rent their primary residence in Puerto Rico?
Well, if they don't, if he's not an investor and he wants to export services, he doesn't have a requirement to buy a house in Puerto Rico.
Okay. Right. Okay. Gotcha.
The requirement for purchasing a house is for those that apply for the Investors Act.
Investors Act. Okay. Right. So basically, like business owners. Gotcha. Okay.
People that generate interest, dividends, capital gains. That is the extension provided by that side of the law.
Okay. Understood. Okay. So clearly, it's very nuanced. You can't just say, hey, I'm going to move to Puerto Rico and I'll be living tax free. They're very, very intricate laws to read and to understand and to comply with. From your experience as a professional, like what are the 3 or 4 main mistakes that people make in moving to Puerto Rico? What things do they not really understand and they mess up?
Well, commonly, it's a closer connection issue, right? But they commonly fail with the closer connection stuff.
Mhm,
Let's say about keeping, and for example, this is a married taxpayer. His wife didn't want to move to Puerto Rico, so
mhm,
uh, she keep living in the U.S. mainland with their kids. Certainly,
mhm,
under the guidelines provided by the IRS, closer connection means that your closest family is with you in the territory.
mhm,
So
mhm,
that certainly exposes the taxpayer to be non-compliance. And basically, for bona fide residency, the taxpayer needs to comply with the 3 tests. It's not one
mhm,
of another. So he needs to comply with presence test. He needs to comply with a closer connection and the tax home. So he needs to comply with 3. He may be in Puerto Rico for more than 183 days. He may work for a Puerto Rico entity or from Puerto Rico, but if he doesn't comply with closer
mhm,
connection, that certainly exposes him for non-compliance. Another error is to think that basically capital gains for Puerto Rico is a full exempt territory. Capital gains, it depends on what's the asset, right, that generated that gain, especially as I mentioned with respect to marketable securities versus private equity. If it is real estate property located in the US, that's still a US source income.
yeah.
So most of them think, hey, I'm moving to Puerto Rico, I will liquidate all my investments right after my movement. And when you take a
Mhm,
look into the holding period or the
mhm,
acquisition date,
yeah.
there's nothing to be allocated to Puerto Rico. Okay.
Mhm,
Yeah, those are the main errors that I have seen. Keeping your days, right? It's an issue that is very important. There are
mhm,
free apps. There are many ways to keep your count your days. It's very important to do that. And another error that we have found that it's right, you can fix that crossing your fingers with the meetings with the IRS is to notify correctly the IRS, right? There is a specific form that is filed with the US.
mhm,
So you need to notify the IRS that you moved to a US territory on time. Okay, it's due
mhm,
by the same due date of the first 1040 right after your movement. So it's very, very important to notify the IRS accordingly. And that means that you need to update your address, right, with all the stuff.
yeah. Mhm,
And
mhm,
use a Puerto Rico banking institution at least for your ordinary expenditures, right? Pay your bills, pay all the stuff, so you can demonstrate that you have closing with the territory.
okay. So physical presence, closer connection, tax home, right?
Yep.
So I've heard people say, hey, the best thing is about this opportunity is that you have to move to Puerto Rico. But then some people say the challenge with this opportunity is that you have to move to Puerto Rico because, everybody's different. And for some people, it's not what they want to do, right? There've been, there's obviously an interest, I guess, in certain discussion groups that I see online would somehow figure out a way of taking advantage of this incredible opportunity without actually moving to Puerto Rico. Are there any loopholes at all, or have they all been closed up in the last few years with changes in the law?
Well, yeah, well, probably, and this is a very, very loophole or gray area on compliance. It's a matter of how it is defined domicile, right? Residency in Puerto Rico tax code means a person that live in Puerto Rico at least 183 days, or it is
Mhm.
domicile to Puerto Rico. But the other
Yeah.
part, if you take a look into the Section 937, one of the close present test options to be in compliance with the IRS and the US tax code is to
Mhm.
be no more than 90 days in the States, in the US mainland.
Mhm.
So for if you comply with the tax form, with your closer connection to Puerto Rico, But in the case of present test, you are no more than 90 days in the US. You may say that you comply as well with the present test in the US and claim Puerto Rico residency. But that only works for passive income, right? Because if the person is dedicated to export services as well, in addition to the passive income, the source of the income will be attached to the location that you provided those services. And those are some loopholes, right? But expose you for other issues with compliance, especially when you are a business owner. Let's say that you operate as well an export company in Puerto Rico, but you don't want to be in Puerto Rico. Then those services will be attached to the location that they were provided. And I forgot to mention another common errors that occurs is a person that open a Puerto Rico entity, transfer all his contracts to the Puerto Rico entity to export services through the Puerto Rico entity, but he wants to live 9 months in Puerto Rico, 3 months in the US. Those 3 months are US source income. So you may expose the Puerto Rico company to be considered a foreign corporation doing business in the US, subject to US income taxes, subject to branch profit tax.
Exactly.
The salaries received by the employee living in the US for those 3 months will not be excluded by Section 933 because those are US source income services provided while living or working outside of the Puerto Rico. So those are things that are commonly analyzed in the process. Sometimes if you will be working outside of Puerto Rico, do that at personal level, not through the Puerto Rico company. So you only offset federal taxes and self-employment tax on that side of the income to avoid bringing the company to pay additional US taxes. So those are issues that we commonly handle to make sure that there are full compliance and clients wants to sleep well. So yeah.
Okay, so I get that if you set up a company in Puerto Rico and you then go and run it from the US, you've created permanent establishment in the US, and obviously that'll be a taxable presence. However, what if you put a full management team in play in Puerto Rico, a CEO, whatever, and then you move back to the US while the company is still effectively managed and controlled from Puerto Rico? So does it matter that maybe the 100% owner sits in the US if they're full staff operations in Puerto Rico?
Yeah, well, basically, first, the export service part, there is no requirements that the owners must be Puerto Rico residents by any means. So it's just a matter of actually making sure that the services are exported from Puerto Rico. So if you are a US owner of a Puerto Rico entity that exports services, that company that has the management team and works completely from Puerto Rico will pay the 4% tax. What you as a US owner may take into consideration is possible issues with the GILTI tax because Puerto Rico entities are treated as foreign corporations for the eyes of the IRS. So those are the main considerations that may be exposed because even that you pay a 4% tax, that there may be an 11.5 effective tax rate based on the GILTI tax. If the company is taxed as a corporation, right, for the eyes of the IRS. And let me give you some background. A Puerto Rico entity, either it is a single member LLC that is organized under Puerto Rico law, is automatically treated as a C Corp for the IRS, okay? Unless you actually make the elections and check the box to treat that LLC or corporations differently for the eyes of the IRS, okay? Certainly US owners, etc. So commonly Puerto Rico entities are treated as foreign partnership or pass-through entities for the eyes of the IRS. But we commonly use also Puerto Rico LLCs for state tax planning and investments, because if the owner is a US citizen, you can elect to be taxed as a disregarded. So any passive income generated by the entity is taxed at the individual level, at the federal level as well. So those are important parts, but that question that you did is very important, especially for possible issues with the GILTI, for setting up entities in Puerto Rico, but still living in the US as a US owner.
So that is a very interesting point. Well, two very interesting points that bounced up with me. One was the fact that just like with an LLC in a regular U.S. state, one has the ability to elect for it to be treated as a corporation or as a pass-through, right? So Puerto Rico does afford that election as well. Is there an election for the equivalent of an S corp? Is that possible?
Can you repeat that one? Sorry.
S corp. So in the U.S. with an LLC,
No,
you can.
yeah, well, in Puerto Rico, we don't have S corps. We
Okay.
have what is corporation of individuals. That is a kind of S corporation. But basically, a corporation in Puerto Rico now can elect to be taxed as a disregarded entity in Puerto Rico. That starts with 2022 tax year. So taxpayers can make the election until the actual tax due date. But basically, an LLC with one member can be taxed as a pass-through entity, as a disregarded entity, or as a C corp. The automatic treatment is to be taxed as a C corp in Puerto Rico. Okay, certainly Puerto Rico has those reasonable compensations as well, etc. But basically, those are the main issues as well right now.
Okay, so that's the first one, the idea of those elections that are available. Another interesting point that you raise is the fact that, as you pointed out, that the Puerto Rican entity is treated as a foreign company from a U.S. federal tax perspective, so it will be subject potentially to GILTI, and it would also be subject, I assume, to PFIX potentially as well as Subpart F as well. Okay, so that is quite interesting to note. So for those who may be going to set up that, trigger CFC basically by setting up that company in Puerto Rico, a controlled foreign corp, some measure of tax planning is probably worthwhile to understand, if not potentially mitigate some of these less desired tax effects of a structure. Okay, so that is interesting to know. I absolutely didn't know that. So that the fact that Puerto Rico is U.S. territory, people born in Puerto Rico, you are U.S. citizens, yet the companies created in Puerto Rico are treated as foreign. So the natural people are U.S. persons, but the entities are not U.S. persons. So that's a bit of a paradox in law.
Yes. And take that one. So that's why basically the tax system in Puerto Rico, it is like it is, right? The economic system has been developed under the premises of tax incentives that may be provided to foreign corporations, including U.S. entities. So that's why you have big pharmas in Puerto Rico from U.S. doing work here for the tax benefit and tax loopholes. But basically, for a tax perspective, we are foreign for citizenship from birth. So individuals still need to pay U.S. taxes unless the income is actually excluded by the U.S. tax code. And for example, the exclusion for wages from Puerto Rico sources is excluded for general taxpayer. But if it is a Puerto Rico born and raised citizen that worked for the federal government, those federal wages are still subject to U.S. income taxes. So those federal employees cannot exclude from U.S. gross income the income received, even that it was provided in Puerto Rico. So it's not 100%.
Okay, so for a U.S. someone born in the U.S. mainland and they move across to Puerto Rico and they receive the equivalent of W-2 income from a Puerto Rico company, or maybe not from a U.S. company, but they're based in Puerto Rico. Under Section 911, if they were outside, like if they're in another jurisdiction like Canada or whatever, under Section 911, they can have the foreign earned income exclusion, right? Based on the physical presence as a bona fide resident says. Can they enjoy that being based in Puerto Rico as well? Can they enjoy the foreign earned income exclusion?
No. If you apply Section 933 exclusion, you cannot apply 2555 forms or something like exclusion for foreign earned income.
You cannot. Okay.
You cannot. No. You can. For example, if you are a U.S. citizen or person working in Puerto Rico, but you are not a Puerto Rico bona fide resident, you first pay taxes to Puerto Rico, and Puerto Rico income taxes are fully creditable against federal income taxes and foreign tax credit.
Right. Okay. So you pay Puerto Rico taxes first. And what for individuals that have earned income from Puerto Rico, what are the marginal income tax rates?
Well, it fluctuates again from 7 to 33%.
7 to 33%, right? And so then you get a credit against your liability to
Yes.
the US. Okay. But you have to work on foreign tax credits, so the Form 1116, as opposed to the 2555 foreign and income exclusion.
That's correct.
Understood.
Yep, that's correct.
Okay.
Yep.
Gotcha. That is quite interesting. So having realized again how incredibly nuanced this is, what advice or how do you advise US persons who are thinking of making that move from the mainland to Puerto Rico? Like what is the steps you would normally take in helping them make that transition?
Well, commonly at first act, if you're actually willing to move, right, and to comply with the U.S. tax law, because this is a full exemption, but it's provided to the extent that you comply with the U.S. tax law. Because Puerto Rico will give you the exemption, right, if you comply with the grant, etc., with those check marks. But you need to comply with those tests provided by the U.S. tax law. The first thing is what basically know your plans. What type of incomes do you have, and what are your expectations, right? This is not something that you move to Puerto Rico in 2023, liquidate investments, and go back in 2024, because the IRS expects some kind of cool down period, right? At least 3 years, something like that, to make sure that you were fully interested and domiciled with your family, etc., with Puerto Rico. Because if not, they will see that as a movement to avoid taxes and some kind of evasion, etc. So first thing is to know your plans. Certainly, what type of income do you have? Because this is not for basically for everyone. For example, if you expect to export services to Puerto Rico, but you don't have investments like interest, dividends, or capital gains, you don't need to apply for both tax incentives. Probably by applying for the export service side, you pay the 4% tax, you receive a W-2, and the dividends will be exempt either way, because the tax decree provided granted to the company will provide fully exempt dividends. So you will not need the other part of the law for individuals investors. So that's one of the things that we commonly explain, because complying with the Individuals Investors Act, it's more expensive. Charitable contributions, you need to actually purchase a home in Puerto Rico, filing fees, etc. The other part is for individuals investors, right? You want to move to Puerto Rico, let's evaluate your investments. We can calculate some projections or expected tax liability in the future, depending when you liquidate your investments, especially on marketable securities and in the case of private equity, right? Because if you hold those investments for many years, you need to hold that additional years after moving, because it is not the same rule, right? Especially if you have the person have kids, if they are willing to move to a Puerto Rico school, or if they are in a school that allows them to live there, that's different, because they may keep U.S. residency because they have a place to live and that they are not required to live with their parents, okay? But if one of the parents needs to be with their kids, that will trigger issues with closer connections, okay? So those are the principal questions that we commonly raise. Investments, Puerto Rico now, it's very similar to the US with respect to information. With crypto assets, with foreign accounts, Puerto Rico, this is the first year that will ask on their tax returns if the person has some PAN accounts located in foreign jurisdiction, like the FBAR. So it's basically the same stuff. Even that it applies, right, for every citizen, US citizen, to notify to the FBAR those ownerships. Now the Puerto Rico wants that information as well. So and the Puerto Rico Treasury shares significant information with the IRS authorities for investigations and all this stuff. So that's very important, right, to know your movement, and I like to know my clients to see if this actually makes sense for them for the movement, right? Because if not, the risk is maybe high, right? For non-compliance, because it will be fully monitored by the IRS in some time.
Right. So, I guess it's helping the client, just to kind of summarize what I've picked up. So it's really helping that client understand the nuances of the law. And while at the same time ensuring that they are ready to become a bona fide resident of Puerto Rico, is not just a matter of going over and counting days and running back and forth.
Exactly.
Basically, your center of life must shift from the US mainland to Puerto Rico. Your life has to move. Okay.
Exactly. Yeah. It's not. It's just not movement, right? It's to make sure that you comply with those rules.
Okay, that's great. Okay, this is an interesting question we got from somebody on YouTube. Someone asked to compare Puerto Rico to Dubai. And if I could, from what I've learned and from picked up from you, if someone is a business owner versus it may be a different, I mean, everybody's situation is going to be completely unique, purely from a tax point of view. If it is your business owner, you may be leaning in one jurisdiction, whereas if you were an employee, then you may lean towards another. So if it is that you have earned income, then if you earn income as a bona fide resident of Puerto Rico, you're going to be paying tax at your marginal tax rate, which goes up to 30-something%. Whereas if you sit in Dubai, it moves with inflation under Section 911. So right now, it's the first 112,000 of income will be tax free once you file the form 2555 or whatever. So it could be completely tax free both to Dubai, because Dubai has no taxes. A little bit of an asterisk there because it does, but generally speaking, no taxes to Dubai, and at least the first 112,000 can be tax free to the US. Above that, you pay to the US. So again, generally speaking, if you are a lower to mid level income earner, then maybe Dubai will be better off for you. If it is that you are an investor, because of the benefit with no capital gains, then Puerto Rico is definitely the one for you, because being a resident of Dubai is not going to shelter you from US capital gains taxes. If it is that you are a business owner trying to run a company, you're probably not going to be much better off either way, because guilty is going to catch you. So it really depends on your portfolio, what your income streams may be. But generally speaking, I think those are some of the considerations as a U.S. taxpayer. If you're not a U.S. taxpayer, it's completely different. Okay. Any thoughts on that? Any feedback on that?
No, it's kind of interesting, but certainly you learn correctly what Puerto Rico rules are. But it all depends, right? Principally with the line that you said, that streamlines of income. That changed basically everything from the decision making to see if Puerto Rico actually makes sense, or Dubai, etc. Because certainly Puerto Rico is kind of the only places, small amounts of places that you can keep your citizenship, right? Still a U.S. citizen, and don't pay U.S. taxes on capital gains, certain passive income. But it's important, right? It's not only the type of income that you generate, it's the source of the income that was generated, right? Because you may be fully exempt at Puerto Rico on interest and dividends, but they may still subject to U.S. taxes because they are foreign sources.
Yeah, exactly. So that leads us to another topic, I think, another question. How sustainable is all of this? Because there's a sense, when you look at the narrative in the international tax space, they talk about a global minimum tax. They talk about income should never go untaxed anywhere. The EU puts pressure on its member states to close those not just loopholes, but tax incentives that skew the movement of labor and capital. Even Dubai, the bastion of tax-free life, taxes are being phased in. Some years ago, we had the introduction of their sales taxes, which is VAT. Now you have the imposition of a corporate tax for domestic facing companies. And there's probably a consensus, a quiet consensus among tax professionals that say in the next 40 to 50 years, Dubai is going to have taxes like everywhere else. So Dubai is the last man standing, is going to fall soon. Puerto Rico, what's your sense? Obviously, you don't have a crystal ball, but what's your sense? How sustainable is this?
Well, I think that basically, at least from the Individual Investors Act, probably, I don't think that they will, let's say, have a lot of years of future for new applicants. Probably there are political pressures right now in Puerto Rico, because all of these movements in real estates, there's a bubble right now on market prices and all the stuff, and basically, if you want to make sure that this type of tax benefits make sense for the economy of the territory, you need to actually act for another parts, right? Right now they only have to or purchase a home in Puerto Rico, but let's say to invest in or put their cash on Puerto Rico financial institutions, so you can like some kind of boom the availability of funds in Puerto Rico financial institutions to provide loans, etc., for the economic movement. So probably if they persist, I think that they will need some changes, that they actually requires more than only living in Puerto Rico and purchasing a home. But respect the 4% tax, it has been decades in Puerto Rico, for the tax benefits, but certainly, and the global minimum tax as well, based on the discussion. I think that may change some kind of the rules for big companies, but at the end, from my perspective, I prefer that territories like Puerto Rico, that doesn't necessarily have all the powers to do or enter into international agreements or international tax treaties, because we cannot do that. We are limited by the U.S. to do that, and Puerto Rico does not participate in any of the U.S. tax treaties. So I think that from that perspective, you need to give or allow these type of territories to promote their economics and incentive by their own, because they don't necessarily have all the resources like any other big country with all the resources that they have to promote the economic development and all the stuff. So we need to offer something, right, to make sure that people move in or open businesses here. But at the end, from the government side, you need to ask for compliance, for investments in Puerto Rico, for bringing funds to Puerto Rico, the creation of employment, and all this stuff. So I think that the global minimum tax makes sense for certain areas and certain type of level of companies. But at the end, I think that you cannot limit countries to promote their location. For example, Puerto Rico is completely full around, it's an island. So the tourism is very important in Puerto Rico. So Puerto Rico promotes the development of hotels, short-term rentals, provides actually tax credits for the investments and the construction of hotels in Puerto Rico. So, and also provides a 4% tax or 90% exemptions on property taxes, etc. So they need to persist, right? If you want to keep moving the economy, creating employees, employment, and all this stuff. So it's a matter of making a balance, right? Making sure that you, from a government perspective, you are fiscal responsible with all the stuff. You have an issue with making sure that you don't have significant tax rates for small and medium families and persons in Puerto Rico, but does not bring all the tax benefits to big companies, right? Because certainly there is a disparity and changes in the persons and actually political pressures to change that. So.
Yeah. So just to kind of summarize what my takeaway is from that, there are two areas to look at. There's the one area in terms of having Puerto Rico as your center of life. Look, there will probably be adjustments around that, either loosening it up a little bit or maybe tightening it. as things evolve. On the other side, the tax rate may move in the various spaces, but it will always be at a discount to the mainland to create an incentive for businesses and individuals to make Puerto Rico their economic home and to bring economic activity. So it may not be 4% forever, but it'll be
Yep.
less than whatever the US mainland is asking for. Okay.
Exactly. Yep.
I gotcha. Giancarlo, thank you very much. You've been super helpful in shedding a light in an often misunderstood area of international tax, that is US persons and businesses moving to Puerto Rico. Do you have any final words? If someone wants to find out more about this and to engage you and your firm, what's the best way to reach you?
Yeah, well, basically, first, thank you for the invitation. It's really a pleasure. I really enjoyed our conversations back in Harvard a few months ago, and hopefully we can join together another way. Basically, our firm is located in the capital of Puerto Rico, in San Juan. My firm, the name of my firm is Thriv, without the E at the end, Thriv LLC. You can find us either on Facebook, LinkedIn, my name, reaching out in LinkedIn, or our website, right, thriv.cpa. And we do taxes, right? I love all this stuff and making sure that the compliance is very, very, very good. So, and I really enjoy talking with people, persons like you, that really interested in this conversation. And I'm following you, all the short videos you do, so I'm keeping informed on what you do.
Thank you very much. So just to repeat, Thriv without the E, dot CPA.
Yes,
Okay.
that's right.
Fantastic. Have a great day ahead, and we'll see you next time. Bye-bye now.
Thank you.